Today we're going to take from standing committees. All right. Hello.
Yes. The
Okay.
standing committees, yeah.
Yes, this one. Okay. Or the committees in an organization. All right. So standing committee can be any committee. Okay. What is a committee? A group of people, right?
Yes.
So in a company, a committee is also a group of people, but it can be, a composition of NADs and EDs together. All right. Okay. So standing committee is any committee, okay, regardless of which committee it is. Okay, it is termed as a coin term for committee as a general. Clear? Okay.
Yes.
So it is a permanent feature that is there in the business. It should be there, all right? And it is there in order to implement the corporate governance. Clear? Okay. And this particular committee can be made up of board of members. Clear? Okay. And they are given specific duties to perform. All right. Okay.
Yes.
And in common practice, there are four committees that are there in the organization. Okay. First one is the audit committee. Okay. And the name itself suggests it is responsible for internal audit system in the company as well as assisting the external auditors. Clear? And the second one is the remuneration committee. Third one is the nominations committee. And last one is the risk committee. Understood?
Yep.
First one, nomination committee. So see, nomination committee is the committee that is responsible for appointing board of directors as well as people in the senior management. Understood?
Yep.
Okay. And what would this result in? This would result in unbiased decision of appointing a director. Clear?
Yep.
Okay, that means there is no favoritism. Okay, there is no influence over the members to select a particular candidate. Clear?
Yep.
So everyone, every senior level managers or every senior and a professional who's managing the company would have an equal chance of getting selected. Clear? Okay. Next one is the audit committee. Okay. And audit committee is the person who is the committee responsible for conducting internal audits. Okay. And also attending to the external auditors when they comes in our company. Clear? When they come in our company. Clear, no?
Hmm.
Okay. And what would this ensure? This would ensure that all the efforts that is being prepared in the organization would have true and fair view. Okay. And everything is done on the IFRS and IAS basis. Okay. And also this could also result in managing the risk and the internal control system. Clear? Okay. And
Yes.
this would usually in turn, improve the entire organization because the internal control system would be sound and dependable. Clear?
Yeah.
Next one is the remuneration committee. And remuneration committee is the committee which is going to fix what should the ED be paid. Clear? ED and NEDs be paid. Clear?
Yeah.
And they are going to set it in a way that it is not going to become what happened in the Carolian company. Clear? Okay?
Yeah.
Clear now? Okay?
Yeah.
This actually ensures that no director is allowed to set their own pay. Okay? And this would in turn make the others fix a salary or fix a remuneration for the EDs and NEDs. Clear? And this would in turn give fairness in decision making. Clear? Next one is the internal audit. Hello?
Yeah. Yeah. I'm listening.
And this particular internal audit works with the audit committee. All right. So there is a parent audit committee, and
Hmm.
under that, there would be an internal audit system. Okay. Which
Yep.
is going to ensure that all the internal controls in the organization is dependable. It is working smoothly. It is working correctly. Okay. Clear? It is very strong in the company. Okay. And as I've mentioned before, internal controls are checkpoints in the company. Okay. It is where there are certain regulations that is kept in the company which should be followed. For example, see, I'm just giving you an introduction of what internal controls could actually be. Okay, when you have joined the company, what you do is before you come to work, you place your thumb in a machine, right? Thumb, you get a thumb signature, biometrics. Do you know about it?
Yeah, biometric signature. Yes.
Yeah. And that is there so that the computer automatically logs in who is entering the organization at what time, okay? And at what time does this person leave? Clear?
Yep.
That is an internal control system. Understood?
So basically, it's a
That,
system.
yeah, it's a system.
Okay.
That is, in airports, they check our passports and IDs, right? Same way in the company, there would be certain systems that are in place in order to check everything. Okay. This is one example. The second example can be when the employee is finally in the organization and he is going to open his computer, he's going to have to, give some ID and password onto the computer, right? And that is an
Exactly.
internal
It's
control system.
like basically in UK here, like they give
Yeah.
like one kind of like chip. If you like in cashier and jobs or like the ordinary jobs, if you
Uh,
go in the company, they have a
uh,
one chip. If you scan it, it means your time has started. Like at
yeah.
what time you come.
Same way. That is
When you
internal
check,
control system.
yeah, it basically is check in and check out.
Yes, it is internal control system. That is second example.
Okay.
Okay. Third example can be suppose you are, you are in the purchase department. Okay. And you need to buy a raw material which costs maybe $15,000. All right.
Yep.
But when you try to order it from your computer, the computer would automatically reject it because anything beyond 10,000 would need a purchase manager approval. Understood?
Yep.
That is also an internal control system. Understood?
Okay.
Okay. So there would be numerous checkpoints in the company, and these checkpoints should be passed before doing anything, right? So that is the goal of internal control system. All right.
Yep.
If the internal control system is good, then that means the company would have less misstatements. Understood?
Yeah.
Okay. Next is the risk committee. Okay. And risk committee is there so that that committee can assess the risk that is faced by the business. Clear? Okay.
Yep.
And this committee and internal control system are related because it is going to closely monitor about all the things that is there in internal control system. Understood?
Yes.
And this particular committee is there so that it can foresee the uncertain future, okay, and predict if there is any adverse effects that the company would face in the future. Understood?
Yep.
Okay. So this is there so that the company's profit maintains and also in order to maintain the strategic goals of the company. That is the goals that the company wants to achieve. Clear?
Yep.
Now, risk can risk is always uncertain. That is, it is something that would happen in the future. Okay. And it is going to bring you an unfavorable outcome. Understood? It is going to bring you an undesirable outcome. Clear?
Yeah.
Now, there are certain examples of the risk that is given. First one is the market risk, right? So, for example, we are operating in a product, maybe we are in electronics, for example. Okay,
Yeah.
the trend, the fashion or the trend keeps changing, right? There are new products in the market, and we have to adapt ourselves towards it. For example, if you are a fashion industry, the trends there also changes from time to time, right? So we have to adapt. Clear? That
Yep.
is the risk. If we don't adapt, we are out of the competition. Understood?
Yeah.
Example, BlackBerry, right?
Yes. Nokia.
Okay. Next one is the credit. Okay. So if the company is not able to, raise funds in order to work, okay, then the company is going to have a risk. Clear? And the risk would be of going concern. Clear?
Yes.
Next one is liquidity. See, all the companies should have a cash flow in them in order to operate on a day-to-day basis, right? So if there is no cash flow, then that means the company is at risk. Okay. Next one
Yeah.
is the health and safety. Suppose a company is very good, it is all right, okay, but it is not complying with the laws and regulations that is there in the company. Maybe with laws and regulations, you need to register every plan that you take for the company to manufacture. When you're not doing that, then that creates a risk. Clear? Okay.
Yep.
Next one is legal. Okay. So if there is any litigation issues, if there is any case against you, if there is any suits against you, that is also a risk. Okay. Next one is technological. That means if your what you choose to, conduct your business with is outdated, that is also going to create a risk. For example, there are new plans in the mission in the market, but we are using the same old mission, then that means it is going to you know give you some risk in the future. Clear?
Yeah.
Next is reputation. See, if the company's image is good, the company is going to work properly. But as soon as the image is bad, the company is going to suffer. Clear?
Yeah.
Next, next is environmental issue. Okay, see, nowadays emphasis have been given on the environment as well. There is sustainable accounting, there is environmental accounting, right? So if the company is not going to follow all that, the company is going to have risk. Clear?
Yeah.
Now, sometimes the company use derivatives. Derivatives simply means that you are using the futures and the options that are there in the market in order to secure yourself from the risk. Okay, but derivatives in itself is a risk. Clear? Clear now?
Financial instrument. Yes.
Next one is the products. Okay. So if we are introducing something new, okay, and the customers are not accepting it, it is also a risk. Okay.
Yeah.
Next one is the input prices. So if suppose what we get as raw materials is too a high of a price, what happens? We have to sell it at a high price in order to cover the cost, right? So this would
Yeah.
also create a risk. Okay. Next one is currency or interest risk. Okay. Suppose there is, adverse movements of foreign exchange rate. There is adverse movements in interest rate. So this would also affect the company. Clear?
Yeah.
Next is political risk. So if the company's government is very strict or very liberal, it would also create some risk. Clear?
Yeah.
Okay. At a time, the government can be liberal. At a time, government can be strict about, exporting and importing goods. So it would affect the company. Understood? Now, we need to manage this risk, whatever that happens in the future, right? Okay.
Yeah.
So all the companies should have a risk management system in place in order to tackle this situation. All right. And what does this
Yes.
give them? This would give them a way to identify the risk. Okay. A way to assess the impact of the risk. Okay. And it also would help them make or take precautions against the risk. Clear? And it would also help them to continuously monitor the risk. Understood?
Yeah.
Okay. So if the company is going to identify the risk, the company is always going to look towards the events that would make an unfavorable outcome towards their profit. Understood?
Yeah.
Okay. And these risks can also affect the objectives of the company. Okay. So all these have to be identified. You have to identify which element of the business organization or which happening in the future might risk the company's objectives or profit. Clear?
Yeah.
Okay. Just a moment. Just a moment. Ready? Hello?
Yes.
Okay. So there are many ways in which we can assess the risk. Okay. So the ways are mentioned below. All right. Now, when we are going to assess the risk or identify the risk, or we want to add it in numbers, first of all, what we are going to do is we are going to look towards the probability of the risk. Clear? Okay.
Yep.
Whether it is 10 percentage probable, whether it is 15 percentage probable, whether it is 80 percentage probable. Understood? Okay. Then we are going to look towards what that risk is actually going to do to our company. Clear? That is the impact or consequence. Okay. Okay. So, for example, we are in a lawsuit, all right, and that is a risk, right? I've mentioned before, litigation is a risk. Okay. Suppose we are in a lawsuit and there is a 75% chance of us losing. Understood? So this would actually create some economic outflow from our company because we are going to lose the case. Understood? Maybe we would have a 1 million loss. Then that means that is a risk. Clear? And it should be expressed in value. We are going to express it in value using some methods. You don't want to learn that. Okay? You just need to know that this is how risk is assessed. Understood?
Yeah.
Clear? Now, the impact or consequence. Okay. So once we have set the probability, okay, we are going to assess the impact of that risk being happening. Clear? Okay. And
Yeah.
this particular risk is going to be ranked on the basis of their happening. Okay. So if we are going to first of all consider whether the risk is high or whether the risk is low. All right.
Yeah.
And this particular method would be done using, pictorial representation, just like, traffic light method, where because high risk is going to be indicated in red. Okay, lower risk, medium risk is going to be indicated in yellow, like that. Clear?
Yeah.
And apart from this, there are many other methods to which you can choose from. Okay. Okay. Now what we are going to do is, when we are going to rank this everything, okay, this particular risk is managed by a method or model called TARA model. Understood? TARA model. All right.
Yep.
In TARA model, the T stands for transferring risk. Clear? In TARA model, the T stands for transferring risk. That is, if we are, taking an insurance over our car, if you are taking insurance over a warehouse, clear? This is actually when something happens, we are going to transfer that risk towards the insurance company, right? We would get money from the insurance company. Understood? This is called transferring the risk. That is T of the TARA. Clear?
Yeah.
Next one is avoiding risk. Okay. So avoiding risk is basically not performing something that would create risk. Understood?
Yeah.
Okay. Next one is the reducing risk. Okay. Reducing risk is such that we are going to take certain precautions which would actually mitigate that risk. Understood? Okay.
Yep.
Now, the last step is the accepting the risk, okay, and bearing the cost and consequence. So, this happens, okay, when we know that there is some risk that is going to happen in the company, okay, and we know that taking measures against it is going to cost us more, all right, it is going to cost us more, okay, but accepting it won't be that much expensive. So, what would we choose? We would accept it. Clear? Okay.
Yeah.
And whatever decisions we are taking about a risk management, okay, or about a risk being addressed, it should be well communicated with the staff. Okay. And
Yeah.
this particular risk, when we are going to find the solution for it, it is written down into procedures and is given to the staff in order to follow them. Clear? Now, while we are assessing risk, while we are identifying risk, while we are mitigating its impact, okay, all the objectives and events would be continuously monitored surrounding the risk, okay. And if there is any objective issue, or if there is anything that is going to happen or deviate from what we have previously planned, then the events are going to be changed. Clear? Maybe the
Yep.
risk won't happen at all. Then that means we have to change the sequence of whatever is happening. Clear? Clear, no?
Yeah.
Okay. Now, suppose the likelihood of happening something is very high. Okay. What happens to the risk? What happens to the impact of the risk? Tell me. If the likelihood is high, what happens?
What did you say?
If the likelihood of the risk is very high, what would happen?
If risk is very high.
Yeah, we would take all the measures in order to reduce it, right?
Yeah.
Clear? Okay, because we know that the impact is going to be high, right? Now, if the likelihood is low, then the impact would also be low. Understood?
Yeah.
Clear? Now, relationship between risk and internal controls. Okay, so what is risk and how is it get involved? How does it get involved with internal controls? Are we discussing next? Clear? First one, in all the risk that is there in the company, in all its activities, while we manage that risk, it always links towards the internal controls. Understood?
Yeah.
Okay. By by keeping internal controls in place in the organization, we are actually reducing any foreseeable risk that might happen. Clear? Okay. So
Yeah.
if the company's internal control system is not good, then that means there is a high chance of, misstatements. There is a risk that the company is going to not work properly. Clear?
Yeah.
Okay. Now, the things related with internal controls is taken the responsibilities of that particular thing, that is the internal controls, vest in the hands of directors of the company. That means they are the ones who's going to create internal controls. They are going to be the ones who is going to implement it. They are going to be the ones who are going to monitor it. Clear? So everything related with the internal controls lies at the hands of the directors of the company. Clear?
Yeah.
Okay. Now, when they are going to place some internal controls, they are going to have to check the effectiveness of that control. For example, they have kept a biometrics for the employees. Okay. So they must make sure every employee is required to, swipe their card when they gets in and swipe their card when they gets out. Clear?
Yeah.
Okay, so they have to monitor that whatever controls they have put in place is actually effective. Clear? Suppose the biometrics don't work. Suppose the swiping machine is, has some errors. What happens? The internal control system is ineffective. Clear?
Yes.
Clear, no?
Yeah.
Okay. Now, what would the auditors do? See, the directors are supposed to make sure that the controls are in place and it is effective. Okay, and they are going to ensure that since the risk is there, since the internal controls are in place, the internal misstatements, that is the FS, is going to be true and fair, right? Okay. Now, what does the auditors do? The auditor is going to assess the effectiveness of the control, but not for the company, but for their audit procedures. Clear, no?
Yeah.
Okay. So for the company's perspective, the director is going to check for the internal controls to be effective so that there is no risk of material misstatement in the FS. That means the FS is true and fair. Okay. The directors don't want errors or misstatements in the FS. Clear? So they are going to make sure that internal controls are very effective. Clear?
Yeah.
See, material misstatement is like, there is something that happens in the FS and it is going to affect the whole dependency over the FS, right? Right? So that is material misstatement. So if the internal controls are in place, then that is going to reduce this material misstatement. Understood?
Yeah. Yep.
Okay. And auditors would want to test the controls so that they are sure that particular internal controls don't create any audit risk. That means it doesn't make the audit provide a false opinion. Clear?
Yeah.
Okay. Now, when there is a risk which is considered by the management, it can be from both ways. That is, it would have an external risk as well as the internal sources, from the internal sources. Understood?
Yeah.
Okay. Now, In order to work properly, the companies need to have a mechanism so that they can identify any susceptible risk that is going to be caused. Clear? Now, as I've told you before, when the risk is identified, when the risk is quantified, all the procedures are to be in set. Okay, all the procedures are to be set in order to mitigate that risk, right?
Yeah.
Okay, and this can be done by using Tara. Clear?
Yeah.
Okay. Now, all the so in this context, we can say that internal controls and risk management are something, both side of a same point, right? Okay, so if the internal control system is effective, risk is going to be low. Or the company is going to be protected from the harmful risks that might cause the company. Clear? So if the internal control is very weak, then the risk is going to be very high. Understood?
Yeah.
Next one is the audit committee. All right. So composition, that means what all is included in the audit committee. All right. So the audit committee would have at least one member. Okay. And at least one member, okay, who would have a financial experience and knowledge. Clear? So if there is 4 members in the audit committee, one should have a financial experience. Clear?
Yep.
Okay. Now, regarding the members, there should at least be 3 NEDs. Clear?
Yeah.
And if it is a smaller company, there should at least be 2 NEDs. Okay. So if it is 5, there should be at least, more than the half should be the NED. Clear?
Yep.
Now, what is the objective of the audit committee? See, if there is audit committee in an organization, okay, they are going to make sure that the company is credible, okay, that the company's FS is prepared honestly, that is, it always contains true and fair view. Clear? Now, the audit committee would also assist the directors. Clear? Okay.
Yep.
So when the financial reporting, as in when we say financial reporting, it basically means publishing the FS in a true context. Clear? So the audit committee would assist the directors in respect of the financial reporting. Clear?
Yep.
Now, the audit committee would also support the company, okay, in establishing itself as an independent committee, okay, which would ensure that regularly an external auditor comes in, okay, audits all the things that are there in the company, okay, and it would in turn attain public confidence. Understood now? Okay.
Yeah.
Now, all the things that the external auditor would require would be provided by the audit committee, okay, and audit committee is going to be the link which is going to make a communication between the board of directors and the auditors. Clear?
Yep.
Now, what are the advantages of audit committee? First one, independent reporting, right? So, suppose there is no audit committee, okay, but there is an internal audit department, suppose, okay. So, this internal audit department would have to directly contact the BOD regarding the things that are there, right?
Yeah.
But suppose there is an audit committee, then the internal audit department would have to go to the audit committee regarding the items that has been come to notice. Clear?
Yep.
Okay. So this would create an independent reporting mechanism, because when there is an audit committee, the internal audit system is going to report everything to audit committee, but not the BODs. Clear?
Yeah.
Okay. So like this, the management wouldn't be able to interfere in, manipulating the financial reports. Understood? Now, frees up executive time. So if there is a committed group which is actually conducting, or which is actually taking up all the tasks that relates to internal and external audits, then that means BODs would have more time in order to concentrate over other vital issues of the company, right? Okay. So the EDs would get a time in order to, provide their expertise in other matters of the company. Clear?
Yeah.
Clear, no?
Yes.
And other matters of the company as in the financial reporting. Clear? So instead of managing the internal audit, instead of managing what the external auditor should do or how much things that are to be provided with the external auditor, the executive directors could actually involve in, providing expertise in the financial reporting rather than doing all those things. Clear? So it gives them, a space to which they can concentrate more over the company's aspect rather than, concentrating over the working of the company. Clear?
Yeah.
Now, audit committee would also monitor the corporate governance code. That means they would make sure that, corporate governance code is, implemented correctly. It is addressed properly by the BOD. Clear? Now, appropriate internal controls. Okay. So, in order to maintain that quality of the internal control system, the audit committee would appoint the internal auditors in order to make sure of it. Clear? Okay.
Yep.
Next is better communication. So if there is an audit committee, better communication channel would be created between the external auditor and the BOD. Okay. Or between the management and the BOD. Clear? So everything would be communicated properly. Clear?
Yep.
Now, what are the disadvantages of committee? See, if there is an internal, an audit committee committed towards, working of the organization, that is controlling the internal control system or monitoring the internal control system, monitoring the internal audit system, providing information for the external auditors. So too much power vests in the hands of the audit committee, right?
Yep.
Okay. This would threaten the authority of the EDs. Clear? Okay.
Yeah.
And why? Because audit committee is full of NEDs, right? And NEDs would have more power than they would perceive that NEDs have more power than them. Clear?
Yeah.
Now, see, we know that audit committee consists of more composition consists of the NEDs, right? And getting NEDs
Yep.
with that particular knowledge and experience is very difficult. Clear? As I've told you before, NEDs don't necessarily have a professional body clearance. They may not have that expertise, right? But for audit committee, we need that expertise, we need that knowledge, we need someone with a financial background, right?
Yeah.
And often it happens that it might get difficult to find an NED like that. Clear?
Yep.
Now, when you're going to appoint a committee, it is for sure going to create additional cost. Clear? Because NEDs are paid. NEDs don't work for us for free. Clear? Now, when we are creating that committee, too much of the work is trusted upon the NEDs, right? That is also a risk. Okay?
Yep.
Clear now?
Yeah.
Now, if there is an audit committee, then that means the external auditor is appointed by the audit committee, not the BODs. Clear?
Yeah.
Okay. This is actually an advantage too. Okay. This is a disadvantage because BODs might feel threatened because the external auditors are being appointed by the audit committee. So no power hands. Clear?
Yes.
But this is also an advantage. Why? Because the person or the external auditor that the audit committee would actually be of greater independence. Clear?
Yeah.
Understood? Now, communication of external auditor to audit committee. So, what is the communication channel? Okay. Now, the audit committee is going to make sure, okay, that there is complete independency. That means there is no, a personal connection. There is no objectivity issues between the board and the audit firm. Clear? That means the board doesn't know the audit firm at all. There is no personal relationship. There is no room for, compromising the objectivity of the auditor. Clear? Clear now?
Yep.
And why is this? Because audit committee would have independent NEDs, right?
Yeah.
Okay. So whatever the audit report is there, they are going to look it at an objective view. That means they are going to look it into a view that doesn't have partiality, that doesn't support the BOD. Clear?
Yep.
Now, the audit report, when published, the audit committee would review it. Clear?
Yep.
And also, while the audit take place, if there is any communication that is to be provided between the BOD, the audit committee is the ones who is going to circulate that communications. Clear?
Yes.
Okay. So the auditor would also benefit from it because their reports are being reviewed carefully. That means the independence is maintained. Clear?
Yeah.
Clear?
Yep.
Next one. The audit committee, okay, can actually, you know, take the advices from the auditor or take the suggestions or take the things that is to be rectified from the auditor directly, okay, and implement those procedures. Clear?
Yeah.
Okay. Now, when you, there is a chance that, okay, if there is no audit committee, the auditor is going to directly communicate with the BOD, right? Okay. And more often, BOD might refuse what the auditor has to say, okay, or the what the auditor has told them to correct, right? Okay. But if there is a medium, if there is an audit committee in between them, then the NEDs might be able to convince the BOD to take everything into consideration, whatever the auditors have said. Clear?
Yep.
That is an advantage. Okay, that is a form of communication that happens, and it happens only if there is an audit committee in place. Understood?
Yeah.
Now, the audit committee, okay, would also have more time, okay, in order to review all the work done by the external auditor, all right, than the board. That means everything is managed by the audit committee. That means from, conducting internal audits, from, giving information to the auditors, okay, from accepting anything that is there, the auditor has suggested, all right, and the reports that the auditor has provided. So all these things are looked over by the audit committee, right?
Yep.
So the audit committee act as a first hand towards the external auditor than the board. Okay. So they have a upper hand in, reviewing everything that the auditor has provided. Okay. Clear? So if the
Yep.
committee feels that the external auditor is not right, okay, or they need to change the things, or they need to change the external auditor, clear? So they can do it on themselves. Clear? All by themselves. Clear, no?
Yep.
Okay, so that chapter is finished. It is a long chapter, right? Very long chapter. And this is also something that is important, Hasi, this chapter.
Yeah. After